Ladies and gentlemen, the next session is entitled The View from Academia, and this is a misnomer when it comes to Klaus Adam, I would say. It is true, he is a Nuffield Professor of Economics at the University of Oxford and a professional fellow at Nuffield College, but he has also worked at the ECB. He's a research professor at the Deutsche Bundesbank, so we know him quite well, our researchers and economists. He's a member of the Academic Advisory Council of the German Ministry of Finance, the chairperson of the Monetary Theory and Policy Committee of the German Economic Association, and a couple of other things else. So if there's one person who knows monetary policy from an academic and practitioner's perspective inside out, it is Klaus. And so we are very happy to have you here for the next 30 minutes. You've kindly agreed also to answer a couple of questions at the end, and then I would say the floor is yours.
So thanks a lot for the very kind introduction, and also to the organizers for having me on the program. It's a great pleasure being here. So, this is going to be a little broad, but I'm going to try to make the talk somewhat more specific. So, if you look at the United States and Europe, I think they have been facing, since the global financial crisis, common challenges, but somewhat diverging outcomes have materialized on both sides, especially after the year 2012. And the three common challenges one can identify are, in the background, two background challenges, and one more immediate one was a secular decline in the real safe interest rate, also sometimes called the natural rate, which has been ongoing for maybe 30 years now. That was accompanied by somewhat more recent and possibly also secular, but we are not entirely sure about that, decline in the trend growth rates. Luckily, the growth rates still seem larger than the natural rates. That's I think, good news. And the third challenge was that we had a very large recession, or two recessions in the euro area, that was accompanied with debt overhang either in the public and or private sector. So if you look at, Charles Evans has mentioned this, at the trend growth rates and the natural rates in the United States, so this is from work from Laubach and Williams, the trend growth rate is the dashed line. It was up until the 2000s, maybe 3.5% in the United States. It had already come down a little bit from the 60s and 70s, but the estimates really have halved since 2010, and trend growth rate is now in the order, somewhat short of 2%, maybe 1.5%. If I understood Charles Evans correctly, the Fed view was 1.8%. So that's way below what it used to be in the 80s and 90s. And so has the natural rate of interest, or the short-term safe real interest rate that is consistent with the full employment and inflation target. It used to be more like 3.5% in the 80s and 90s, and now it's more like 0.5%. So a 2.5% decline of the natural rate in the United States. If you look at the euro area, the qualitative picture looks very similar. So the dashed line is again trend growth rate. So in the 80s, 90s, it was slightly north of 2% maybe, but it has since come down to somewhat, north of 1%. So this is almost a 1% drop in the trend growth rate in the euro area. And similarly, if you look at the natural rate of interest, or the short real safe rates, they were also more like 2% prior to the year 2005, but have since come down to 0 or possibly even negative. So a 2% plus maybe 2.5% drop in the natural rate of interest in the euro area. And of course, these developments pose big challenges for monetary policy, in particular in a combination where you are in a situation where the natural rates of interest are zero, potentially even negative in the euro area, and you're faced with a large recession as the global financial crisis. What happened was that monetary policy was constrained, and it was constrained by the lower bound on nominal interest rates, and it was constrained much more than we anticipated prior to the global financial crisis this to be possible. I think this came as a surprise to everyone that you would have multi-year zero nominal interest rates or even negative rates. And in part, you know, one of the things that have been tried, like forward guidance, proved in the end to be much less effective than our economic models suggest. So in an exercise of humility, I'm actually going to present some of my own failures along this front first. So if you look prior to the financial crisis, you know, at the available studies that perform a quantitative evaluation of the effects of the zero lower bound on how it constrains monetary policy, there were two papers that I've written together with Roberto Billi just prior to the global financial crisis, and they concluded that given the historic shock sizes prevailing in the US economy since the mid-80s, so the 20 years from the mid-80s up to 2005, we should expect that the zero lower bound would bind relatively rarely, and if it does, only for very short periods of time. And if you have a period of lower bound that effectively constrains policy, it can be effectively dealt with by promising somewhat higher inflation in the future through forward guidance. In particular, the zero lower bound, given historic shock sizes, would not be a reason to materially move up the inflation target for the central bank. So, of course, you know, the shock that eventually hit in the 2007 crisis was much larger than those that hit in the prior period. So this is one reason of the failure. But I think the more you know, structural issue was that when we performed those analyses, we assumed an average natural rate of 3.5% at the time, which was roughly the average that, well, 20 years later, Laubach and Williams have estimated for the 80s and 90s periods in the United States. And this has come down by around 3 percentage points. So the fact that lower bounds are not constraining policy was conditional on this natural rate staying where it was, which effectively it hasn't. Okay. Now, the lack of room to stimulate the economy now via conventional interest rate policy and potentially non-conventional interest rate forward guidance then caused, you know, large-scale quantitative easing programs to be implemented on both sides of the Atlantic, somewhat different timing, but you know, these effects you know, couldn't paste over that we had very different economic outcomes on both sides. So here is, you know, since the year 2000, I'm graphing you GDP growth in the United States, that's the blue line, and in the euro area, that's the red line. And you see prior to the great financial crisis, so the average peak to peak, roughly 2000 to 2007, the euro area and the United States performed very similarly. So the growth divergence there was 0.2 percentage points, so very similar. You see the euro area lags a little bit the United States cycle, but in terms of averages, this was pretty close. But following the year 2012, you see quite considerable divergences. That gap widened from 0.2% to 0.7%, so it increased by half a percentage point over this 7-year period, 2013 to end of 2019. And you also see the time periods in which the divergence emerged. They were associated with the sovereign debt crisis in the euro area, 2012-2013, as well as with the diverging fiscal policies towards the end of the sample, where the United States implemented a big tax cut and regulation cut, while in the euro area we haven't seen any of that. So if you ask for, you know, what is the source of divergence between the euro area and the United States, I would say it's less monetary policy, which has, you know, implemented very similar tools. It seems to be more on the fiscal side. In terms of the inflation, we can also see some divergence, and that is possibly more worrying. If you look at the inflation average in the United States post-2012, it sort of is at 1.5%. That is CPI inflation. And in the euro area, it was about 0.9%. So both of these figures are obviously way below the stated inflation goals of these central banks. But more worryingly, it is for the euro area, which has a lower natural rate, that also has experienced lower inflation rates. And therefore, real interest rates exposed in the euro area have been further away from the natural rate in the euro area than they have been in the United States. Okay, so there is this divergence in growth and output. So what contributed to divergence? I alluded to it. It's possibly fiscal policy in those periods that we can see the big growth divergence. And one institutional difference between the euro area and the United States is that euro area fiscal policy is, I may say, facing some institutional fragmentation, to put it optimistically. So one thing is that we have independent fiscal authorities, okay, and after the year, the immediate response to the crisis that was taken in 2009, following that year, there has been very little coordination between these fiscal policies at the euro area level. So we have very little coordination, and that is certainly one dimension of fragmentation. The second thing is that we face countries with very different positions. There are some countries which have high debt, and especially high debt relative to the level of fiscal credibility that they can project into the financial markets. And there are other countries which face relatively low debt given their level of fiscal or political credibility. And that, of course, complicates this dimension, especially the second dimension of fiscal policy, fragmentation, complicates the life for monetary policy. In particular, if you don't have fiscal credibility, any quantitative easing operation potentially generates redistributive effects. If you purchase assets by driving down their nominal interest rates at very high prices, and there is a possibility that these assets in the end may not repay, then you're sure to have a political fight going on. And you can see some of this certainly ongoing. So QE operations in the euro area, unlike in the United States, have been politically much more contentious, and therefore maybe QE has been deployed also somewhat later than it has been in the United States. So what does this now mean for monetary policy? I think the fiscal fragmentation, you may hope for the best, but it's unlikely to change anytime soon. We're going to be stuck with the situation for quite a while. And then the question is, how will monetary policy deal with the lower natural rate and the inability to really engage in the non-standard measures with the same forcefulness as the United States has been operating this? Should monetary policy in the euro area really regularly deploy quantitative easing operations in the future? I think this is somewhat, would be very difficult if you guarantee the price of government debt and have independent fiscal authorities that sort of are free to do what they want. So I think this is certainly not a long-term framework on which you can operate. So how can we deal with this? I think in the euro area in particular, where this problem is present, we somewhat need more room for conventional monetary policy. We need to create room for conventional monetary policy to face one fact, the lower natural rates, especially in the in euro area, and the fact that the QE operations are going to be problematic. Now, there are two ways you can go for more, to generate that room. One is you can say we provide the institutional setting that would allow us to implement more negative rates, and certainly some of the recent decisions in terms of tiering have been going in that direction. So you want to limit the side effects by exempting inframarginal units from the negative interest rate, and that may allow you to go somewhat more negative, but I think the room is eventually limited because vaults will be built and cash will be put there if you go too far that direction. And the other direction is potentially a higher target, so that next time round, at least in the medium term, you would have more room to lower. Now, the medium term, I think target revision might have to be considered unless some of the underlying fundamental forces, change suddenly to the positive. So if there would be less fiscal fragmentation and there would be an asset that the ECB or the Eurosystem could buy without having to participate in discussions about redistribution of monetary policy, that would significantly change that. Or if there were sufficient structural reforms that would raise the natural rate and the natural growth rate, that would certainly also go away. But of course the fear is that neither of these will happen anytime soon. So let me now become a little bit more academic and say a little bit what the monetary policy literature actually has to say about the optimal inflation target of a central bank. And it's going to be quite sobering. Okay, so if you look at the main arguments that have been put forward in economic models for the optimal inflation target, they all look very different from what central banks currently do. So there's the old argument by Milton Friedman that says you should eliminate the distortions between cash and credit and therefore actually run a deflation. Okay, that's one answer. Then there is a celebrated book by Michael Woodford that showed that in micro-founded models that have some nominal rigidity, sticky prices, that these models actually call for a zero inflation rate to be optimal. Okay, that's also quite some distance from what central banks are actually doing. Then there's an argument by Martin Feldstein that says if you have progressive taxation that doesn't index tax rates to the nominal to the real income, then if you get inflation, that's going to be bad because you're effectively going to increase the distortions in the economy by having higher marginal taxes. So again, zero inflation would be optimal. Okay? Then there is the zero lower bound, and there was some hope that that could justify optimal policy to be to lead to positive average inflation rates, but quantitatively it doesn't seem to work in the standard models. You get a few basis points, maybe a positive inflation target of 0.5%, I think is a fair summary of that literature. So this is also quite some distance away from what central banks are actually doing. And then the last argument is probably true to James Tobin. He says if wages cannot be cut, nominal wages cannot be cut, then it's good to have some inflation, because if you want to lower the real wage but you can't lower the nominal wage, inflation is going to take care of that. But this argument is very beautiful but extremely difficult to quantify, because you would need to know at the level of an individual worker what the level of productivity is to see whether really the nominal wage is constraining, is way above the marginal product, the nominal marginal product at that point. And then there's the whole discussion in the background. Wage contracts are long-term contracts. Are wages allocative at all? Okay, so this is basically giving you no answer because it's very hard to quantify. And if you ask now, how do all these different arguments play out in central banks' models, the current generation central bank models? Quantitatively overriding is actually Michael Woodford's argument. In fact, all modern central bank models, dynamic stochastic general equilibrium models, the standard suite of models, they all imply that actually zero inflation target would be approximately optimal. And I think that tells you that there's quite some distance between the academic literature and what central banks are doing. Okay? So now to promote a little bit more positively my own work, we have been revisiting the issue of the optimal inflation target in sticky price models, and this we have been doing with Henning Weber, who's at the research department of Deutsche Bundesbank. We have just one paper published in the AR and a new one that I want to talk a little bit about. And we showed that positive rates of inflation are possibly much less harmful than these simple models of central banks suggest. In particular, it's easy within sticky price models to rationalize positive amounts of inflation on average, like 2, possibly even 3%, as being optimal if you include a more realistic supply side, okay, into those models. So what do you mean by more realistic? Well, I mean a model that features things that we actually see on the supply side of the economy, like product turnover. There's a lot of new products generated in the economy and old products exiting. And there is a second fact that products display a life cycle patterns for their prices. They enter relatively expensive, and in relative terms, relative to the competing products, they tend to become cheaper over time. So there are relative price trends in the economy that the standard models are not capturing in any way. So let me illustrate this for you in a simple graph. So on the axis here below, there is time, and the price is on the vertical axis, and each inclined blue line represents a product that enters with a high price, then stays over its lifetime, but the price is falling over time. And there's a staggering of products and a staggering of falling product prices over time. In the way I've drawn this figure, the average price of products in the cross-section remains constant, okay? So there is no inflation, and the relative price of products is actually falling, so the price, and so is the nominal price. So in such a situation, why would it be not optimal to have this vertical line of average prices being zero, having no inclination, no inflation? Well, the answer is, if there is some friction in adjusting the prices, as we know there is from the data, prices get adjusted infrequently, then the actual adjustment path is not going to look like this efficient, smooth decline. It's going to have infrequent, large jumps, and that is going to lead to deviations of prices from being optimal, okay? So with a zero inflation rate in this environment, you would get price distortions, much as you would get the non-zero inflation in the standard New Keynesian model. So then what is the answer? How should we deal with such a situation if in fact relative prices are declining? Well, you could have instead relative price declines being engineered by average prices falling. So every product could come in at some price, ideally keep its price constant over the life cycle, new prices coming in at higher price levels, and therefore the relative price of any given product is falling because the average price of the products around is rising. In other words, there's going to be some inflation through new products, okay? And what is the optimal rate at which the average price should rise? Well, it's exactly the inverse of the efficient relative price decline that I've shown you on the previous slide, okay? So now the question is, of course, can we quantify this in some sense? And the answer is yes. We can estimate the efficient relative price declines from the data, okay, and then look what the distribution looks like. We have done this for the UK economy. So we have looked at more than 1,200 expenditure categories which underlie the construction of the UK CPI. And we have looked at the relative price of a product relative to the average price in that expenditure category and estimated those slopes. And these are the slope distribution we get. So you see the zero, that means no relative price trend, okay? And then you see that 90% of the product categories actually face, downward trend in relative prices, and the units are in percent per year. So -5 means these products on average in that category decline at the rate of 5% per year. So this would be a product, if you had it only Dutch products, it would be optimal to have a positive inflation rate of 5%. But of course, there are a lot of products where the rates of decline are much smaller and much closer to zero. So the optimal inflation rate will have to trade off across all those expenditure items, okay? And we actually provide a closed form solution for how you optimally trade off. And then we're going to show you what this data, these rates of price decline, actually going to imply for the optimal inflation target now for the UK. Now, if you look at different good categories, what is the average rate of price decline in different good categories? What we see is that the usual culprits show very large rates of decline. So, clothing and footwear, anything with a fashion component, obviously has the largest rate of price decline, almost 10% per year on average, okay, across products. Communications has a rate of price decline around 7%, okay? And then there are other things which have, much less, like alcohol, beverages, tobacco, nearly no price decline. So there's a variety of relative price trends in the economy, and if you aggregate those, what is the optimal inflation target that this would generate? Well, this is the time pattern that we get for the UK economy. So back in the 1996, which is when our micro price data starts, you would have an optimal inflation rate of around 1.4%. Okay, but since then, these relative price declines have significantly accelerated through a variety of channels. We don't know yet what caused this acceleration, but if you take this acceleration into account, then by the end of the sample in 2016, the inflation target is more than 1% higher than it used to be at the beginning of the sample, so closer to 2.6%. We also perform, obviously, a variety of robustness checks of this, and those indicate that potentially the inflation rate is actually could be even higher, the optimal one. So you have now a setting where the optimal inflation rate is positive, and where the central bank may want to target positive rates of inflation. And our plan is to extend this analysis using the micro price data that is going to be collected within the Euro system in the Prisma network, and to arrive at a similar estimate for the Euro area, maybe as soon as the data is available. Yeah. Okay, so let me now conclude before opening up to questions. So I think, I've argued fiscal fragmentation in a world where the natural rate of interest are very low will constrain monetary policy, especially in the euro area, to stabilize, because QE is such a contentious issue. And unless some of the underlying, fragmentation forces or the lower interest rates disappear somehow, it's probably likely that euro area monetary policy needs some more room for conventional policy in order to deal with downturns in the future. And some recent research suggests that maybe the welfare costs of positive inflation targets are much lower than the standard models used currently at the central banks suggest.
I'll collect a couple of questions.
Dirk Schumacher, Natixis. I have a question, Klaus. What do you think about QE then done purely on the national level? By the way, the purchase under PSPP, the risk remain on the national central bank's balance sheet, in principle at least. But what do you think, if this is such a problem, to make this decentralized, that each central bank in the end, well, still some way coordinated, can decide what to buy and how much? I guess in Germany, higher rates would be appreciated, while in other countries rather low. What's the problem with this kind of experiment then?
Hi, what do you mean by fiscal fragmentation in Europe? My point being, our fiscal no coordination in Europe. If they were coordinated to have no fiscal impulse, would that be more positive? Wouldn't the difference between the US and Europe be actually that Europe had much more active fiscal policy than the Eurozone or Europe as a whole did? It's not a matter of fragmentation, but also of size, and we're just working around it, but not really addressing whether we want more active fiscal policy or not.
So you focused on giving an argument of why kind of an inflation target above zero makes sense out of the academic literature. In the previous presentation, we heard about inflation actually being too low, following on that target. The question is, does your research shed any light on these trends that inflation has kind of been undershooting the policy targets that central banks have been setting?
Okay, so yeah, let's start with this. So So to Dirk's question, I think, so it's true, technically, QE purchases happen predominantly on national central banks' balance sheets, and only to a small extent the ECB is actually buying. But of course, in order to purchase these on the national central banks, the central banks need to issue money, and the question is whether that is really insulating other countries from potential redistributive effects should some of the bonds not repay. And I would severely doubt that this is a sufficiently strong institutional safeguard that makes the problem go away. I think it's certainly helpful, but it certainly leaves open the issue as to whether redistributive issues still around. In this sense, I would be, very against permitting national central banks to independently decide on their own QE program. We can all picture how that would end. I think it's not hard to think about that. So the fragmentation question, so the question is, should we have been more active? Should we have been more forceful? I think the initial response in Europe was very forceful, but thereafter we sort of changed course given the experience on the sovereign debt crisis. We thought we need to lead by example and sort of become fiscally credible to avoid the bigger risk of having the run more widespread than the initial countries that it focused on. There's certainly a role for more active fiscal policy in getting inflation back to target, I think, given that the monetary tools are largely exhausted in the euro area, and the only other option seems to be around to get to the current target seems to be fiscal policy. That's my view. So does our research shed some light on why inflation is too low? I think yes, definitely. The reason is structural forces like a low national rate. Well, but that's of course a kitchen sink for many structural things, together with a combination of a zero or effective lower bound that's somewhere between 0 and 1% maybe, that sort of constrains the stabilization tools, and the absence of fiscal coordination on providing stabilization at the euro area level. I think that can easily explain why inflation has been undershooting persistently. I think we would not have seen that had we seen, would we have had 2 or 3 percentage points more room to lower than we actually had. So in this sense, this is not surprising in light of the models, the inflation experience. If anything, the models would have suggested that inflation should have been much lower than it actually has during the recent episode. Yeah.
I find your line of argument very compelling and elegant. And I must say that I'm, with my question, a little bit on unsafe terrain because I'm not an inflation measurement specialist. But a colleague of mine recently explained to me that actual inflation is undermeasured by measured inflation for a very similar reason than what you showed. And the story goes like this. So if a product decays in price over time, clothing, electronic stuff, and then, so this is measured by the official price indices, and then a new product replaces the old one, but the link between the old one and the new one is not made by the statisticians because it has a new product number or it has some improvements, it's a different piece of clothing, and therefore this hike in the price level from the old to the new product is not measured and not shown. So that actually works against your line of argument, because actual inflation for this reason would be higher than measured inflation.
Right, so let me maybe just answer. This is an excellent question, because we know there's a lot of quality mismeasurement by statistical agencies, but it is an orthogonal question to what we are after. Suppose this is the world we see, okay, and we wrongly, interpret the price increase as quality, okay, and therefore we don't measure that. Then our method would also say you shouldn't have, and that would not be a reason to have inflation. So in a sense, there are two errors that cancel each other. If I measure relative price trends wrongly because I don't properly account for quality dynamics, I will also have a wrong measure of inflation. And therefore, both of those things actually cancel out. So our method, we show this in the paper, is actually immune to quality mismeasurement. It's a thing that's completely orthogonal to the question I've put forward. So, and it's very simple. The argument in a way is very simple. You mismeasure relative price trends to the extent you don't account for quality, but then you're also going to mismeasure inflation in exactly the same way, and that thing is going to nullify each other.
Okay. Thanks, Klaus.
Thank you.